Public finance. This is the act of raising revenue through taxation and other means, and the pattern of expenditure to be followed towards influencing the economic activity. So when we are talking about public finance, we are looking at ways that government can raise revenue. That is the sources of what? Government revenue. And one of the key sources of government revenue is what we call taxation, and other means are there. Having raised revenue, then we also look at the pattern of expenditure that government will follow. And what are they trying to do? They want to influence the economic activity. So when we are talking about public finance, we are looking at what? Raising revenue, how the revenue will be spent, and in spending the revenue should be towards influencing the economic activity. So when we are talking about public finance, it is concerned with government revenue, government expenditure, public debt management, government budgets, and revenue allocation. So when you have raised revenue, maybe you are using it toward expenditure. Are you trying to use the revenue to offset the debt? Because before debt can come up, you must have taken loan from an institution or institutions. So you are thinking of how you are going to manage the debt. Not only that, having gotten the revenue, how are you going to spend it? Is what the budget will be talking about. That is the estimated revenue and the proposed expenditure. Not only that, allocation of revenue. How are you going to allocate the revenue? Maybe among the tiers of government that they have in the economy, or allocating the revenue into sectors that they have in the economy. So we are still talking about public finance. Objectives of public finance. Number one, to ensure equitable distribution of income. That is, government engage in these activities in order to see that in the economy there is no uneven distribution of income. That's why government put in place taxes in order to tax those with higher income heavily and distribute it to the poor ones. Not the poor ones are not paying tax, but they pay at a lower rate. Number two, to ensure employment opportunity. We say that government try to raise revenue in order to carry out its own function, its own activity in an economy. So government is there to also provide job opportunity for people in an economy. Number three, to ensure balance of payment equilibrium. Government want to ensure that in time of international trade, they are not having balance of payment. That is, they want to ensure balance of payment equilibrium. They are not having deficit that can lead to a serious problem toward the economy. So, with the help of public finance, it will ensure balance of payment equilibrium. Number four, to ensure price stability. One of the roles of government is to ensure that prices of goods are stable for a longer period of time. Once an economy can experience this, then inflation will be they will not experience unnecessary inflation. So the economy will be stable. People will be willing to invest in such an economy, not a situation where prices of goods and services are fluctuating anyhow. So with the help of public finance, it will ensure price stability. Number five, to improve the living standard of the people. Government is in the economy as well towards seeing that the people in the economy are living fine, providing essential commodities that the poor ones cannot find it easy to buy. So government engage in this activity. So essence of public finance is to see that the people in that economy are having good living standard. Number six, to diversify the revenue of government. We have defined public finance as raising of revenue through tax and other means. So government will not restrict itself to one area, but government would like to diversify, looking for other ways of deriving revenue in order to carry out its function, that is, in order to carry out expenditure that are very important in the economy. So that's why I say public finance is just to raise revenue Not only that, thinking of a pattern of expenditure to apply in order to influence the economy toward better way. Sources of government revenue. I haven't explained public finance as way of raising revenue. Let us see the available sources of revenue of government. Some are before us here. The first one is taxation. We see it as a compulsory levy imposed by government on individuals. The second one, royalty. Royalty that is a revenue from a mining area of the economy. And when we are talking about rent from government properties, it is revenue from government property. Then the third one, profits of public enterprises. Governments have various public enterprises. Fetching them were revenue year in, year out. So the profit they are deriving from this place is one of the sources of government revenue. From NNPC, from Nigeria Railway Corporation, from NTA, Nigeria Television Authority, Nigeria Radio Corporation. All these profit they derive from this are part of a government revenue. So there are many public enterprises that government is running. So profit they derive from this is one of the sources of government revenue. Number 4, grants and aid. Grant can come from anywhere, either from the rich one within the country or outside the country. So they can get assistance from those countries. Then aid, likewise, they can also get that from foreign countries, particularly developed countries. They can assist them. So it's one of the sources of government revenue. Licenses. Government can give you license or people to make use of. So revenue will still be derived from that. Maybe permission to drive on our highway, permission to use some resources, and so on and so forth. So in terms of license, government can get revenue. Take for instance now, if you want to establish a bank, you must get license. If you want to establish an insurance company, you must get license. If you want to establish a telecom firm, you must get license. All these are revenue to the government. The next one is borrowing. Borrowing can either be internal or external. When you say internal, this when government borrows from banks and other financial institutions within the country. But external borrowing, that is getting the fund outside the country. So it's still a source of our government revenue. The fine is another source of government revenue. Fee is another source of government revenue. And levies is also another source of government revenue. All these are our sources of government revenue. That's why we say taxation and otherness. Taxation. This is a compulsory levy imposed by the government on individuals, corporate bodies, and goods and services. So when we're talking about taxation, we're talking about compulsory levy, and it is the government who imposed such a levy on individuals. Not only individuals, corporate bodies, that is business units, business organizations that are available in the economy, as well as goods and services that are consumed or produced by the people in that economy. And why government is doing it, they were imposing this compulsory levy, is just for government to have revenue, that is to have funds in order to carry out its own function in an economy. Not only that, taxation can be used towards moving the economy forward, that is controlling influencing the economic activity of a country. Types of tax. Number 1, direct taxes. These are levied directly on individuals or corporate bodies by the government, such as personal income tax, company profit tax, capital transfer tax, and so on and so forth. So in terms of direct tax, we are talking about levies imposed on individual income, likewise on company profits. So that's what we call direct taxes. An example is what we mentioned as personal income tax. That is from individual income, government carry out such tax. In terms of company profit tax, that is on companies, on corporate bodies, government do that on their profit. And when you say capital transfer tax, A situation where you're trying to transfer your share capital from one level to another, or your capital from one place to another, right? So we are going to pay tax. That's why they call it capital transfer tax. Number two, indirect taxes. These are levied on goods and services, such as custom duties, excise duties, value-added tax that we call VAT. So we're talking about indirect tax. It's not a levy on individual, but on goods and services that people consume in an economy. So that's why they call it indirect tax. It's irrespective of the good or the service. So each and everyone in that economy will pay tax. Principle of taxation. Number one, equity. That is, people should pay tax according to their ability. So what we're trying to understand here is that not each and everyone that we have in the economy should pay equal, but it should pay according to their ability. People earning little income should pay little tax, while people earning higher income should pay higher tax. So that at the end, there will be equity in that economy. So that's why we call it principle of equity under principle of taxation. Number two, certainty. When you say certainty, the amount, manner, and time of payment should be known to taxpayers. That is, each and everyone paying tax should be able to know the amount, the manner, and the time of payment. Number three, convenience. When we say convenience, it should be easy to pay and be collected. It should be easy to pay and be collected. So whoever wants to pay should find it easier in paying, and someone that is in charge of collection to also find it easier in collecting. It should not be something that will be difficult for people to pay or to collect. Number four, economy. When we say economy, the amount they are going to work to spend towards collecting the tax should be very minimal. That is, the cost of collection should be very minimal. Not spending up to 50% in time of collection, and it implies that you are not getting revenue at all. So we are spending 50% in collection of tax. Definitely, it implies that they will. So, in collection of taxation, it should be very economical. So that's why we move our economy. So the cost of collecting should be very minimal. Number five, flexibility. I want to say flexibility. It should be something that can be changed according to the economic situation in an economy. So the economic situation will tell us that okay, there is a need to change the rate they are paying as income tax or as company profit tax or on good. But if it is rigid, then it will not pay the economy. So principle of flexibility implies that it should be easy to change towards the economic activities of the economy. Then number six, simplicity. I want to say simplicity. It should be very simple for people to calculate. That is, the taxpayer should find it understandable in calculating the tax, the amount they are going to pay, what they should take out. The allowances that should be taken out before calculating the tax. So if it is not simple, people will try to avoid paying tax. So for tax to be payable, then the principle of simplicity should be applied so that each and everyone will understand the amount to pay as tax. Public expenditure. We've explained that in public finance, we'll be talking about taxation, we're talking about public expenditure. So these are another aspect of public finance. And what do we mean by public expenditure? This refers to expenses which the government incurred towards providing social amenities and adequate security of the state. It is the government spending from revenue derived from taxes and other sources. So we said it that in public finance, we are looking at the pattern toward the pattern of expenditure that government will adopt in order to influence the economy. So government is there to provide social amenities, not only that, adequate security of the state, in order to see that the economy is moving forward. Classification of public expenditure. You can classify government expenditure into two. The first one, capital expenditure. What do you mean by this? These are those that capital stock augmenting. And what do you mean by that? Spending in the construction of physical assets such as buildings, roads, bridges, and so on and so forth. So when we're talking about government capital expenditure, we are looking at expenditure toward construction of physical assets. The second one is current expenditure. These are spendings on running costs or day-to-day running of government affairs, such as payment of salaries, administrative costs, maintenance costs, and so on and so forth. So government cannot avoid these in a year. So we are talking about the cost, what it takes them to carry out their affairs in order to see that the economy is moving forward. So that's why we call it recurring expenditure. We are talking about expenditure that government cannot avoid in a year. So it's a thing that occurs year in, year out. But when you compare with capital expenditure, it's not every time they continue having only road, but other visible assets will come up. But this one, government cannot avoid it in a year. So it is an expenditure that government will surely incur. Types of public expenditure, and at times we can call it items of government expenditure. The first one we call it general services. So we are talking about expenditure that government cannot avoid in a year, but in terms of our administrative expenses and maintenance expenses. So government cannot avoid it, so we call it general expenses. The second one is social services. And we are talking about social services, we are talking about expenditure on education, on health, anything that has to do with social services. The government allocate funds into this area. So the expenditure is what we call social services expenditure. The next one is economic services. And we're talking about economic services. We are looking at expenditure towards agriculture, manufacturing, and commerce. So anything that has to do with economy. So expenditure that government is carrying out toward it become economic services. Then the last one we call it defense and security. That is in terms of the armed forces and police. So in order to see that there is security in an economy, so government try to allocate funds into this area. So expenditure toward this area is what we call defense and security expenditure. Effects of government expenditure. Number one, provision of basic amenities. This, when government carry out expenditure, they do it purposely to provide basic amenities. So with the help of basic amenities in an economy, it will make the economy to move forward and to allow the people in the economy to enjoy their life. Number two, it has effect on the establishment of industries. That is, where we have government spending, it will make other industries to come up. Even the incoming industry will find it easier because of what availability of amenities in that economy. So when government is spending, government is not just carrying out expenditure, but they are spending so that more industries can be established. Number three, provision of employment opportunities. What government can engage in activity, right? There is no way employment will not come up. The government is trying to ensure that there are a lot of job opportunity in the economy. So that's why government is spending. Number four, improving standard of living. Government wants to ensure that there are amenities, there are goods, there are essential goods and services that can improve the living standard of each citizen. So government trying to improve the living standard of the people. So that is why they spend towards goods and services that can move the economy forward, that will boost the life of the people. That's why we said improving standard of living. Number five, ensuring peace and security. So government is also spending towards security of the world, of the country, not only the economy. So when there is security in the economy, there will be peace in that economy. Or when there is peace in an economy, there will be security in that economy. So government is spending towards ensuring that security and life of the people in the country are secured. Examples. Question 1. Which of the following sources of revenue is crucial to government? A. Profits of public corporation. B. Taxes. C. Fee. D. Borrowing. The right answer is B. Taxes. Question 2. The following are direct taxes except A. Excise duties. B. Company profit tax. C. Personal income tax. D. Capital gain tax. The right answer is A. Excise duties. Question 3. Principles of taxation should not be A. Flexible. B. Simple. C. Rigid. D. Economical. The right answer is C. Should not be